well, let's dive in on what this means for the market, the economy. We have two experts here. We have Joe Brusuelas, RSM Chief Economist. We also have Keith Lerner, Truist Chief Market Strategist. Great to see you both. Joe, let me start with you. So some improvement, it looks like. Wages really the headline in this report. What do you make of it?
All right, let's hang a hat on it. The 3-month average annualized pace slowed to 4.3%. If the underlying pace of inflation is at 4%, it means in the next 3 to 6 months, we'll see wage growth slow beneath that. That's when you start talking about, well, it's not just time to pause. It's time to consider when that first eventual rate cut's going to happen. Well, I'm in the camp. It's not till next year. And actually, I think they ought to hike 50 basis points at the end of the month. I really do. Let's get to that range between 5 and 5.25% and then stop. Right. And let's let the lagged impact of all those rate hikes work its way through the economy. But if you're smart money, you're actually already in the market. You probably started to move in the middle of last year, and you're going to begin increasing your positions in anticipation of the pause and then the rate cuts next year.
Keith, your turn. Tagging you in. Your read on today and that point of view from Joe.
Yeah, well, first, great to be with you on this Friday. Happy New Year to you all. Listen, I think today's report was solid. It was somewhat Goldilocks, and you had a market that was, of course, caught offside somewhere. You look at some of the sentiment numbers that came in yesterday, about 20% bulls. And towards the end of last December, or since the second half of December, we saw really heavy selling in funds, and we think part of that was tax loss selling. So some of that subsiding also helping as well. So yes, we think that we have a little bit of a rally here, some good news that likely has further to go. But our point of view is you have to be more tactical this year. We're still somewhat more defensive, and right now, given current estimates, and let's just say those earning estimates stay where they are, you're trading at about a 17 times earnings today. Let's just say you go to 18, which is towards the top end of the pre-pandemic range. That brings you to 4,100. We think that's towards the top of the range, so we would use strength towards that area to actually reduce risk for the overall market, because we still think that all these Fed rate hikes that are in the pipeline are going to weigh on the economy. And the last point I'll make is we kind of think this is somewhat of a reverse Tepper trade, is what we've talked about recently, which means back, last decade, David Tepper, the big hedge fund manager, said either the economy is going to get better and that's going to support the market, or the Fed's going to support the market. Today, we have almost the reverse of that, in that the economy is going to slow down, and that's going to hurt corporate profits, or it's going to stay strong and the Fed's going to continue to weigh against it.
Joe, when the Fed is looking at this report, though, certainly we have seen wage growth begin to cool, but that unemployment rate falling to 3.5%. To what extent does that kind of complicate the picture and complicate the Fed's approach to this, just in terms of determining the current state of the economy right now?
Well, that's what's going to hold the Fed back, because it's the household survey where they derive the unemployment rate from. Mm-hmm. 630,000 people actually exited the workforce, according to that survey. That's why the unemployment rate dropped from 3.7 to 3.5. If you remember, Jay Powell basically said, look, he does not think all those 55 years older and older people who've left are really going to come back. And for the first time, the Fed actually said, and I thought this was really interesting, 550,000 prime-age people were hit by COVID. They're not coming back either. That means the Fed's made an a priori decision that this labor market's going to remain tight for the remainder of this cycle, likely through whatever slowdown or recession we have, and then into the next business cycle. This just isn't going to look like all the recessions in your models that you've put together since the end of the Cold War or before.
Yeah, this may be peak labor force participation.
It
seems like those workers are gone. So, Keith, how much more work does the Fed have to do? And because of that, what do you make of the bond market moving ahead?
Well, we are positive on the bond market. We actually increased our allocation late last year. We think bonds are back. Obviously, we're having a good day today. And, we still think, even with this number, and maybe it's more of a second half type of thing, we still think recession risk is relatively high. So we like, high quality fixed income, keeping it simple. We think there's value in the short end, but also you want to kind of barbell that with longer term, high quality government securities if that recession risk starts to build in. But I think what you're seeing today is maybe that pushed back a bit relative to expectations, and everyone, or the consensus, is pretty negative to start the year. So I think that's helping the market today.
Joe, you also mentioned that risk of recession. Do you think that's a sure thing at this point, or could we still potentially avoid one and get that soft landing?
Okay, so it's not a sure thing. I've attached a 65% probability, so I'm in that camp. Mm-hmm. But when I see sort of the Congress at the end of the year put an additional $45 billion in defense spending on the table, well, that's going to help offset some of the hole that's going to be blown in private sector investment once we see the economy decelerate, right? So, it's going to be a very close call. I'm not expecting a recession that resembles anything like we've gone through in the past 30 years. It's more like going to be like what we saw in the early 1990s and again at the turn of the century. Shallow, short, not much of a duration, but we're going to call it a recession because the unemployment rate's likely to move up towards 5% by the end of next year.
Yeah, we've heard Mark Zandi refer to it as a slow session.
Slow session,
that he thinks.
Mark's very creative in that way, isn't it?
That sounds about right. Is that how you see it? Keith, and I just want to clarify, earlier you said if earnings stay as is, do you think we're looking at further downgrades to earnings ahead?
I do, and that's why the point was, hey, even if we take earning estimates, the consensus today, and just say they stay where they are at 230 on the S&P, today they're trading at 17 times, and if you go to 18 times, that brings you to a little bit above 4,100. We think there's downside to those earnings as the economy slows later in the year. And then more specific to the question about short and shallow, I think that makes sense because of the labor market, because consumer debt levels or service ratios are low. I would just caution, though, that I think the one thing that can make it different is an outlier event, because I think there's going to be more fiscal restraint and monetary restraint relative to the pandemic before, and because of the scar tissue the Fed has because of this inflation that we've seen in the last year. So I think that's just something to keep in mind. Why could it be different than the short and shallow, which is kind of become more of a kind of general view?
What kind of outlier event?
Well, that's it. You don't know, and that's the thing about last year. That's the thing. Like last year, no one was predicting, Russian invasion of Ukraine. So when the economy is slowing down, you're just more susceptible to a deeper downturn. If that happens, you're not going to have the ammunition in our view relative to the past. Again, it's hard to invest on an outlier scenario, but I just think that's where something can go against the kind of short and shallow theory. But I think it makes sense from a base case standpoint because of the employment picture and the debt ratios that I mentioned.
Let me help my friend Keith out here. Clearly, the drama going on in D.C. is on everybody's mind.
Yeah.
Right? We hope that ends soon rather than later. It does appear, though, the likelihood of a debt ceiling debacle is increasing, probably around mid-year. And if you think about the last thing we need is stress at the short end of the Treasury market in T-bills and increase in credit default swaps on the United States, which would actually cause an increase or tightening of financial conditions, probably when the Fed's paused for the past few months or is about to pause. So the timing of that could be very problematic and is a risk nobody who works in financial markets, economics, or policy can ignore based on what we've seen the past 4 days.
You mean the debacle on the House floor, do you, Joe?
I'm not going to talk about it, Dave, but I just teed you up, my friend, and knocked that over the fence.
Oh, my goodness. We'll get to that later in the program. What a mess. Joe, good to see you, sir.
Good to see you guys here.
Keith Lerner, also good to have you, sir, as well. Happy New Year to you both.